So this is a point where we're saying that managers may pursue objectives that increase their own satisfaction. So this idea, so the managerial theory of the firm is for you guys who are now, when you manage a firm, it is beyond just the profits. You are managing stakeholders, you're managing shareholders, you're managing partners, you're managing clients, and in totality, all these form the objective of the firm, which is different from the idea is to maximize profit. But one of the challenges that has been observed over the years is that if you go against the objectives, for instance, of the shareholders, no matter how well-meaning you have this all-rounded view when it comes to these two different types of models. Okay, so if I go back to the neoclassical model, so in the neoclassical model, and you can take note, in the neoclassical model, we are focusing on profit maximization, cost minimization. You want to minimize the costs, and then you're also looking at revenue maximization. So these are the three things. Now let's look at them in a much broader, in a much deeper detail. So when you look at the first one, when it comes to profit, it's the easiest for us to understand. And so you're basically selecting total revenue and total cost is the greatest. So in this marginal revenue of the firm, MR is equals to marginal cost. And this is the point that I was explaining earlier on, that the moment you identify the proper scale of production, and then you know that at this level of production, I am meeting all my operational costs, or my total costs, then from there you can, for every unit of input output. So remember the principle of marginal returns to capital. At some point, there's going to be a negative return. And so you have to make sure that the way you structure your production is at the point where you are, for every funding, increasing the inputs, at some point, your marginal returns are going to be negative. And so it's important that you understand that principle. When it comes to cost maximization, profit depends not only on the revenue, but on the costs. So in this case, as minimize costs in so many ways. You may look at improving efficiency, and this may be maybe automating the production process. You may automate it. You may adopt better technology. You may also reduce waste. So in the production process, there's quite a number of things that happen. For those who are, for example, keeping in the poultry sector, you find that that one poultry sector, you may start a horticulture garden that is using the chicken droppings that are coming from the poultry as manure. you're going to pursue. So if I'm making bread, for example, my revenue is obviously the price of one loaf of bread multiplied by the number of units that I have. So if I'm selling 100 loaves of bread per day, I can maximize revenue by selling more units. And so instead of focusing on 100, I can find ways of making sure it goes to 200 or 300. And this can happen through so many ways. You can say, can I have more outlets where others are also able to sell on my behalf? Can I enter new markets? Can I introduce new products? If farmers or if your clients are not buying the commodities that you have, you may also, decide to enter new markets. And then expanding distribution is also one of the things that you can also look at. But one of the things we want to note here is that increasing revenue alone does not guarantee higher profits, because the costs may also increase. And so as you are talking about increasing the cost of production, look at also the capital investment required for that increment. If you are able to tweak your production process in such a way that you can produce double what you're doing at the same, with the same level of machinery that you have, then you are actually going to maximize revenue moving forward. Okay, so now that is basically under, just to summarize it for you in short, what we have learned under the neoclassical model is that it still assumes that the only objective of the firm is profit maximization. And the profit can be maximized by, doing a number of things. So you're basically looking at maximizing the profit itself, and then minimizing the costs, and then maximizing the revenue. And we've looked at how those three things can happen from a neoclassical perspective. In the managerial discretion model, we're saying that profit is not the only objective, because the environment within which the firm operates is complex. And as a manager, you need to manage all the different players around the firm, starting from the business owners, other stakeholders, your clients, and your competitors. So you have to manage all those different things. And we look at, from a managerial discretion model, again, we also look at two main things. Number one is the sales revenue maximization. And so in the sales revenue maximization, you are looking at, how can you make more sales at the lowest cost? And so as a manager, you may prefer higher sales, because the higher sales that you are going to have within your firm, would mean that you're going to have a greater market share. You're going to have, a better reputation. Your brand is going to be trusted, and you're going to make more revenue, obviously. So we're looking at sales revenue maximization under the managerial discretion model, and then the managerial utility maximization. Now, let me just say a few words about the managerial utility maximization. So under this one, we propose that managers maximize their own utility rather than profits. And that's the example that I gave about maybe having a CEO that worked for this bank over that bank. So what they come with is basically beyond just the profit. They also have some certain level of utility, and they will be able to advance that agenda, which is beyond the profit of the firm. So this we have covered. Now let's look at, so the sales maximization model is under the managerial discretion model, is what I looked at. So these are the models that you find under the managerial discretion model. So we explained the sales maximization model. And in this case, we're basically looking at how can you sell more units under the same production circumstances. Kombe, please, I see your hand is up.
Yes, docs. I'm a little confused. So you were looking at, we were looking at the managerial discussion model, but then are you saying there are other models under the model? I'm getting confused because now you're talking about sales maximization model.
Yes, so sales maximization, managerial utility model, these are under the managerial discretion model, the first two. But then there are also other alternative models that you find in books that can fall under managerial. And these are, for example, the multi-period profit maximization rate of growth model, the Maris model, as well as the William integrative model. I hope that answers your question.
Yes, but I first, when we started, I thought we were looking at two models, which is the neoclassical and the other one. Then yes. You zoomed in on managerial discretion model. And then after that, you were again talking about models that are under this particular model. Maybe that's where I went, that's where I got lost. Because okay. I thought we were talking about, we were on the managerial models and now looking at the issues under that model. So again, I had models under managerial discretion model.
Okay, all right. Now I'm going to summarize it for you even better so that you understand. So if you can take your pens and papers, I want you to write a table with 6 rows and 2 columns. 6 rows and 2 columns. In the first column, I want you to put the neoclassical model. And in the second column, I want you to put the managerial models. This is a question that was coming from you, Kombe. Under the managerial models, I covered the first 2 as part of the managerial models. But the last 3 that you're seeing are also models that fit under the new school of thought, which is on the managerial model of the firm. So when you write the first 2 in an exam, you're fine. In other books, you may find the other 3 that are listed in this bullet point. So when we lump these on the alternative models, when we lump them together, they fall under managerial models rather than the neoclassical. And so in the table that you wrote, I want you to write the following. So under the neoclassical model, the line below that, you can write profit maximization. Just that word, profit maximization. And then in the same line, but under the managerial models, you can write multiple objectives. Then on the line below, under neoclassical model, you can write this short sentence to say owners and managers have the same interests. Owners and managers have the same interest. Under managerial models, you can say owners and managers have different interests. You come back this side, under neoclassical model, you write the following. You can say focus on efficiency. Under the neoclassical model, you can write focus on efficiency. Same line on the other side under managerial models, you can write focus on managerial goals, focus on managerial goals, sales, growth, and prestige. Focus on managerial goals, sales, and prestige. Then you come back to the neoclassical model. The last point I want you to write is suitable for small owner suitable for small firms. Just say suitable for small firms. Then under managerial model, I want you to write more applicable to large firms. More applicable to large firms. So I want us to explain in detail each line, starting from the objective of the firm. I want people in the class to answer. So we look at the first one. You know, neoclassical profit maximization, managerial, multiple objectives. How can you explain that? Is there anyone in class who can take this question up? So the table that we've written, I want you to explain the point number one, the comparison between neoclassical model and managerial models. The first one, who can explain the first one? This is what I've been explaining from the time we started today's lecture. So just for you to, yes, Kombe.
Doc, I think for me, in the way I understood your explanation is the focus for a business that is modeled on neoclassical theory could be just on profit. So maybe it could be like just mass production, and then on mass production at low cost, and then they maximize on profits. But if you're looking for if you're looking at a business that is modeled on the managerial perspective, the objective is just not profit making, but also issues of maybe how the products are marketed, and also maybe issues like the way the business is operating, the environment itself, in terms of issues of is it corporate responsibility, and many other objects or aspects that a business should look at, depending on the environment in which it's operating. I think that's the way I understood it in a nutshell. Thank you.
Great, Kombe, thank you. Thank you for that reflection. Does anyone want to add on the first one? Adding to what Kombe mentioned? So managerial, we're basically saying that, you know, it's now coming to more complex organizations. And if you look at the economic development stages of countries, firms have also been evolving. So on the managerial side, we're looking at managing the business owners, that may be one of the objectives, managing their interests. You also look at, managing your competitors, managing other stakeholders in order for the firm to be successful. So in addition to the points that were mentioned by Kombe. Let's go to number 2. Anyone who can pick up the second line in differentiating the two? Kombe, is that a new hand? Isaac.
Good afternoon, Doc. I just wanted to ask, looking at the models that you've listed on the alternative models, so could I be correct if I was to say the way we are making comparisons on the two models, that is the neoclassical and the managerial models, if we were to add these 5 under the alternative models and make comparisons again, where I would list the characteristics of each model. So would I be correct to say if we put the neoclassical model, managerial model, then we put sales maximization model, and then we put also managerial utility model, and then put down the points or characteristics for each one of those? Would I be correct if I was to do that?
Okay, so the managerial, good question, Isaac. So the managerial models are all referred to as alternatives, because in traditional microeconomics, we only had the neoclassical model. So the managerial is all these alternative models. What I think I should change the wording in this bullet point. What you see on your slide are all managerial models. And in the table that I gave you, you are differentiating between the old school of thought, which is the neoclassical, and the new thinking. The new thinking is all these models, we're calling alternative models, all of them are under managerial discretion models. Does that clarify your understanding, Isaac?
Yes, it does.
Okay, great. Do you want to reflect on the second point that I asked you to write? Differentiating between your classical model and the managerial models? Isaac?
Oh, sorry, I thought it was meant for the whole class.
No.
So,
You can take it up.
okay, so what was the question again?
The table that I asked you to write, the second bullet point, could you add more flesh to it? In comparing between the neoclassical and the, yeah.
Sorry, maybe let me just look at it further. Can you come back and respond?
Okay. Who wrote the table? Can somebody read out the points we have under the second bullet point? Can somebody read it out to me? Clement?
It says owners and managers have the same interest. That's under neoclassical. Then under managerial model, it's saying owners and managers have different interests.
Mm-hmm. Do you want to expand on that, Clement? Anyone who wants to expand on that? Clement, you're muted. I don't know if you were talking. Do you want to expand on that? Okay. So in terms of the second bullet point, just to explain it again, because the concept is very basic, a firm is relatively small, and even the structure of the firm may be maybe a sole proprietorship. So in that particular case, based on the old school of thought, under the neoclassical model, the objective of the firm is to maximize profit. And profit maximization is basically making sure that you're able to break even and make profit on top of that. And remember the earlier explanation, what I was saying is that, as businesses have evolved over the years, it has been discovered now that, to run a successful firm, you need to also be able to understand the environment within which the firm operates. And so managing or having the objective of maximizing profit is not sufficient in itself, because you need to understand, gather intelligence on your competitors, do all these different things. But when a firm is small, at this particular case, you find that the interest of the business owner and of the manager is the same between, according to the neoclassical model. When you go to the managerial models, the ones that you're seeing on your slide, owners and managers may have different interests. Because the firm is big, you find that maybe there's a shareholders, there's a board of directors, and then there's a management team. And so under managerial models of the firm, the understanding is that the business managers, the interests that they have are beyond profit. That's number one. And their interests may be different from that of shareholders. And so as a manager of the firm, your idea would be that you are, you want to have a larger market share, you want to have a better reputation, for example. These are things that happen under managerial models. When you go to the third comparator, we're looking at the focus on efficiency. And so when maximizing profit, and this is an example I gave when I was talking earlier, that you want to look at how can you automate your business processes, for example, adopt better technology for you to be able to achieve or get more output at the same level of input. So we're basically talking about productivity. The rate at which you are producing, can you increase it? And that is, what we look at in the neoclassical model. But in the managerial models, we're looking at, we focus on managerial goals. How do you manage your team so that they can give you the best out of their skills? So how do you manage your team? How do you manage your partners? How do you manage your sales? And it may also be, prestige. You just want to maintain a certain brand and a certain style of management, because that's what you have, come up with. And this is where I gave you the example of, like, somebody who's coming from Barclays, they go to Standard Chartered, they may want to move with certain things, that they've been known for when they go there. So meaning that their objective in that particular firm is beyond just them making profit. And then the final comparator here we're looking at is the issue of neoclassical models, which is why these alternative models have now come up. Neoclassical models are suitable for small firms because the understanding in terms of how it was conceptualized is that a firm operates primarily just for profit, without having to consider the environment within which the firm operates and the dynamics that come with the firm operating in that particular market. Whereas managerial models, they are more suitable to large corporations because you are managing like a complex company, a company beyond just profit maximization. So these are the key differences when you're looking at, the neoclassical model as well as the managerial models of the firm. Okay, so if you Kashia?
Yes, Doc. So I'm seeking clarification on the third one, where the new classical, you said it focuses on efficiency, which means that under this model, we see that managers focus much on providing a service or goods at the lowest possible available resources. But when you look at managerial one, their focus is on sales, growth, prestige. So does it mean that under managerial, they don't really focus on the costs? Like they just want to achieve the sales, the growth in sales. Cost is not their concern.
That's a good question, Kashia. Thank you for asking it. Does anyone in class want to give it a go? Answer that before I come in. Does it mean under managerial models of the firm that managers are not focused on profit? Anyone?
Question. I think
Great. Thank you so much for raising that point. It's a critique, you know, like people are saying we're too basic. The neoclassical model is too basic, just looking at profit. But there's more to profit in terms of managing a firm, and exactly what you've said. So we are assuming when we're doing the comparator, the comparison that, you know, in the third point that you asked, that in addition to the profit in the managerial model, they're doing all these other things. the things that Kenny just talked about. Wishart, over to you.
Oh yeah, yes. I think it's almost the same thing, Doc. I did actually consider as a model was profit, but unlike a classic model, profit is actually a major focus. For managerial, of course, they're looking at other areas as well, like market share, welfare, and so on, putting all other into consideration. But what I wanted also to say is that directors that we have worked with, most of them actually focus much on the bottom line and have no much passion for other sectors. Go back to the organization. You find that this is a CEO, his focus is just the bottom line, is just the profit and so on. So maybe that's just one thing that I wanted as well to just include.
Okay. Thank you so much, Richard, for adding that. I think it's now clear for all of us. Any other question on this? And then we can a few words on the managerial model, like, model by model, just for you to take note. So what each of these models mean. So all of them are lumped under managerial models, the ones that I'm showing right now on the slide. So let's go to the first one. The first one is the sales maximization model. So under this one, William was the first person who proposed this model in 1959. And under this model, in terms of sales maximization, William argued that managers aim to maximize sales revenue rather than profit. Okay, so provided that the firm earns a minimum level of profit acceptable to shareholders. So if, for example, you are employed to manage a branch, a ShopRite branch, if your management team, your senior management team gives you a target in terms of the minimum level of profit you need to make per month, according to William, managers would try to just achieve that, but focus more on maximizing sales rather than profit. So what are we saying here? What we're saying is that, if you are the manager of a firm like that ShopRite branch that I talked about, you need to first of all understand the minimum profit required by your shareholders or your senior management team. And then after meeting that profit constraint, you as a team, you can choose a certain level of output where total revenue, total sales is highest. So, and this example works for example, a business where you are manufacturing things. So it may be that you are producing blankets and they tell you to say the minimum, production you need to do is maybe 100 blankets per day. And out of those 100, if you can sell 50, then that will be acceptable. Or out of each blanket that you make, you are making a profit of 2 kwacha. If you look at it that way, you're making a profit of 2 kwacha if you're selling one blanket at 10 kwacha. So you may meet that 2 kwacha limit, and the minimum number of blankets you're selling per day, they say sell at least, out of the 100 that you make, sell at least 80. So for you, you'll be able to sell those 80 and you meet the target, but you won't stop there. As a manager, you would want to work on turnover, right? The more units of blankets that you sell, ultimately is going to lead to higher profit. So for you, you focus more on, maximizing the sales revenue rather than just the minimum profit threshold that has been put by the shareholders. And so to increase your sales, if you are that manager working for that plant that is producing blankets, you may look at a number of factors to say, okay, what can I do? If I'm unable to sell more than 80 blankets in a day and I'm making 100, let me reduce the price maybe. So you may look at things, different elements. You may say, okay, maybe reducing the price of this particular, of one unit may entice more people to buy because you're increasing now the buying power when you reduce the price. And of course, you may do calculations to say, okay, if I reduce the cost, I may recover my profits on the turnover. If I sell double the 80, obviously then the profits are going to increase. You may also look at increasing advertising. You want to advertise more, so you may reach more people. You may also look at, for example, improving the quality of the blankets that you're making, or you may introduce new products. So ultimately, you need to understand out of this sales maximization that when you do the actual calculations, you find that where sales turnover is high, profits are actually higher than where you have higher profit margins, but low sales turnover. So you want to maximize sales rather than maximizing profit, because the profit threshold may be met. And this is what we see, for example, in businesses now. You find that they will tell you to say, buy two and get one free, for example. That's one way of increasing on, making your products more appealing and, having more, maximizing on the sales. You want more of the units to go, even though it may mean that you're reducing the price. But when you do the math, you find that the more sales revenue you have over time, the sales turnover, it will actually translate into more profits, when you look at the broader picture. So this is the sales maximization. And for the model to operate, it assumes quite a number of things. Number one, that the ownership and management are separated. And so the management team has to have a level of autonomy for them to make these decisions that I'm saying now, to say, okay, instead of us just hitting the target of like 80 blankets per day, how can we increase it? So if you have discretion as a management team to lower the price a bit, to allocate more money towards advertising so you can reach more people, then this model can work, because then only then can you maximize your sales. The other assumption that also that holds true when it comes to this model is that the manager's reward depend more on sales rather than profit. And so if you go in a company, most companies now have adopted the sales revenue maximization approach, because they look at sales turnover rather than profit. And if you go in a company where they focus more on just the the profit, you may not see any incentive for you as a manager to implement the sales maximization models. The other assumption you need to look at also under this model is that shareholders only require satisfactory minimum profits. And so where they tell you that, okay, for us, out of every 100 units that you make, at least sell 80 per day. And out of each unit sold, we want maybe 2 quarter, So they give you those targets, and you can now achieve those targets if you can go beyond achieving those targets by maximizing sales rather than just hitting the profit margin. So this is the first one. So the sales maximization model. And then after that, we have Williamson in 1963 that now talked about the managerial utility model. And under this one, William argued that managers will maximize their own utility, instead of the shareholders' profit. So own utility, in this case, we're talking about your own personal interest as a manager. So under this model, William was saying that managers derive their own satisfaction, for things like higher salaries. And so they may want to come to the firm because the firm offers more money. And so it could be a higher salary. It could be a larger support staff, where they have more people that are supporting what they're doing. It could also be prestige. It could be job security. It could also be other incentives that come with the job. For example, I'm joining this company because I'll be given a person to hold a vehicle. I'll have a nice office, and also I'll have discretion and autonomy when it comes to investments. I'll be able to invest in the things that I consider to be important. And so this is what managerial utility talks about. And even the example I gave earlier, you find that there's like a signature management style that comes with different individuals. So individuals will come with, different ways of managing, and this is explained a lot by Williamson in the managerial utility model. Now, under this model, three key assumptions, stand out. The first one is that managers will have autonomy, and that shareholders cannot perfectly monitor what the managers are doing because of that discretion that they have, and that managers are going to seek personal benefit rather than the benefits of the company. So this is basically what we're looking at when we're looking at the managerial utility model. Now, we move to the multi-period profit maximization model. In this particular model, they're basically looking at, long-run profit maximization rather than just looking at the profits that you're going to make today. So instead of you maximizing today's profits, firms maximize the present value of profits over many years. How does this work? And so the first thing that managers do under this one is to recognize that today's decisions are going to affect what will happen tomorrow. So it could be that there is a piece of land, which is like prime land, which may be good for setting up maybe a filling station if you work for a petroleum company. And today's price, it may look like expensive, but it will be a bargain tomorrow. So how you make a decision in terms of whether or not to go for that depends on how you are evaluating the profit today. So basically like the time value of money. So once you understand that what you do today can affect tomorrow, then you begin to go a little bit deeper in terms of understanding the implications of the investments that have to be made. And so a manager may deliberately reduce the current profits by investing in things like, research and development. And so that same piece of land I talked about, you're saying, okay, I know a few government projects that are going to be set up as well. I think they will be completed maybe in the coming 2-3 years, and they'll be around of land. They'll be around the same land. So you may invest in things like research, things like training of the staff. You may invest in marketing or new technology now with a view of getting more profits in future. And so these investments, they can increase productivity and demand in the future. So like right now, we are talking about the way the automobile sector is slowly transitioning to electric vehicles now. So if you are in the automobile sector, you may want to start training your staff, capacitating them in managing electric vehicles away from, the traditional, fuel-powered engines that we have. So that is one example of you investing now with a view of getting the profits over a period of time. And so the objective, why you're doing these investments now, is to maximize the total discounted value of future profits. So your future profits are dependent on how you are preparing yourself, to serve the market and the demands that are going to evolve as you head into the future. So this is basically what we are talking about in terms of the multi-period profit maximization. It's by looking at how you can position your business in a way that will be able to be, that will be able to respond to the market needs and maintain your current profits and even better because you're more prepared than your competitors. This is what this particular model talks about. And it also makes a number of assumptions. We have 3 of them. The first one is talking about the firm should have, medium to long-term planning goals. So if you work for a firm which, for lack of a better word, which is like small, not futuristic in terms of they're not visionary, this model may not work because they won't see the benefit of why you want to start investing for things that may not have a benefit today. And also future profits may be estimated. That's also the other assumption that we're making. And when we're going to look at value for money calculations, we have a topic just focusing on that. We understand how we can estimate, net present value, the time value of money. If you have 10 million now at the current value, how can you estimate its value in 20 years? Things like that. So that is on the multi-period profit maximization growth model. And then we now go to the Maris, model. Maris also argued that managers would tend to maximize the balanced growth rate of the firm rather than on profits. And so he was talking about balancing the rate at which the firm is growing. And he identified 2 key things in how he modeled this. The first one was that the growth of demand for products depends on what the firm is doing, and that the growth of the firm's capital also depends on how the firm is managing the demand. So 2 things, growth of demand for products as well as growth of the firm's capital or assets. They have to be balanced. You have to balance these 2 things. So according to Maris, he was saying that a firm can expand in 4 ways. Number 1, it may introduce new products. It may diversify into new markets. It may increase investments. It may also acquire other firms. That's where we hear things like a merger. A merger where, one company buys another, or they agree to merge to form a joint stock company. So according to Maris was saying that growth continues until the desired growth rate of the managers equals the acceptable growth rate for the shareholders. And so it's balancing how you're responding to the demand for your product, how you're investing, and how your assets and capital are also growing. This is what Maris talked about. The final one is the Williamson integrated model. And so according to Williamson, he says that this model is integrative, first of all, by combining the profit objectives with the managerial objectives. So this integrated model is basically agreeing again to say we cannot let go of the neoclassical approach. Neoclassical approach is okay. We have to look at it where we look at the managerial aspects plus the neoclassical, which is the profit model, and that you can pursue the different goals simultaneously. So this one is easy because it integrates just the 2 things that we talked about. Okay, so this is a conversation around the alternative model of the firm. The next things that we want to look at now is to look at risks and techniques of managing risks. And this is what we're going to look at tomorrow. And then I have a group assignment, which I'm going to send through the class representative, and then it can be shared with the rest of the group. So at this point, I'm going to stop and ask if there's any contributions or questions that you may have. And just to say, enjoy your lunch and the rest of the day. Great. No, thank you, class then. Bye-bye.